We're going to be talking about ecoeconomics and why it is becoming more prominent as part of the investing journey. We do a strategy review every week, and we use that as a mechanism to communicate with our LPs. So, first of all, um, deep condolences to all those who have lost their loved ones in the flooding in Texas. So I hear that about 100 people lost their lives, and that two particularly school children who were on a summer camp. Very unfortunate incident. Now, um, as a brief introduction, um, what is ecoeconomics? It is a triangular relationship between financial, social, and environmental sustainability. I didn't invent this mechanism. I saw this in practice with more than 100 listed companies, about 100, other unlisted private companies that were following this. I took the learnings from um, what I observed because these companies are highly profitable and sustainable at the same time. They've been working on sustainability uh, related programs for the last 15 years, 20 years, whatever it is. And they are highly profitable. They are able to attract a larger client base. And as part of this, ecoeconomics is very closely tied to what we call as the aspirations gap. What is that aspirations gap? This is basically half the global population is below the age of 30, right? And those below the age of 30 are aspiring for a digitally interconnected, sustainable future for themselves. And on top of that, there is a shift in mindset, right? Right from the way the under 30 generation wants to work, they want to consume, they want to invest. Everything is quite different. And this gives us about 15 different trends that we track as part of ecoeconomics. And this is clearly laid out in my second book, Ecoeconomics 2, Investing in a Youthful Sustainable Market. So in the book one, we looked primarily into what is the decision making model behind this and how companies can be very sustainable and profitable at the same time. In book two, we looked at the investing mechanism, the underlying trends, how this aspirations gap is playing out in the market. Now, who is ecoeconomics based investing ideally suited for? It's definitely not for everyone because if you are looking at a moderate 7%, 8% yearly return out of your investments, etc., you're probably happy with where you are, and this is probably not going to be for you. Who is it for? It is for three categories where we are seeing the most amount of traction. Number one is individuals who are investing for their children and or maybe their grandchildren. So it is longer term, it is legacy driven sort of investing, individual LPs too. Second category is family offices who have a track record of investing in ESG, in environmental and social direct investments, sustainable real estate, etc. That sort of trend. It is it is very very suited for them. The third is institutions, where we find that the institution has an environmental target, a social target. They are investing based on that. So these are the three types where ecoeconomics literally fits in. So if you are into one of these types, then please let me know and we can have a chat. We can discuss further about your investing needs. So how do we work on this? So first of all, we run a hedge fund. So obviously, a hedge fund is a high risk investment. And this is ideally suited only if you have a high risk tolerance level. So for your existing ESG focused, longer term, environmental and social good sort of focused, future driven, legacy preservation oriented portfolio, we can be a very good addition, give you that additional uncorrelated return that you crave for. That is where we typically fit, and that's the type of investors that we attract. Now, in today's session, as part of the strategy review, we want to challenge some conventional wisdom, which we typically do in every weekly session. Why some of the traditional economic models that have guided investment for decades is it's not that they are wrong. It's showing their limits, right? It has stretched beyond a point and it is showing their limits. And how we can look through, we can say, another set of glasses, another lens, which is the aspirations gap, ecoeconomics, uh, and thereby you can have a differentiated investment strategy, um, which is oriented towards the future. Now, now, there are three things that I want you to consider here. One is your traditional economic model showing the limits. Thereby, all of the investment models and mechanisms that are oriented towards that are also showing its limits. So your top investment returns are going to be capped at a certain level. And on top of that, there is significant amount of unpriced risk in your investment portfolio. When I say unpriced risk, now we talked about this, the flooding in Texas. There are weather related risks. There is basically a demographic shift. There is a work related trend. There is a age and investing style related trend. There is also um, the need for, I would say, a smooth transition, and thereby there is a transition risk related trend, EVs, etc. How things are changing on the ground. So based on that, there is a unpriced risk in your portfolio, which your investment manager might be aware at this particular point of time. You don't know how to tackle it. That's the reality. Most LPs that we talk to find that this unpriced risk has already come to their notice at some point or the other, right? But you're not at a point where you're going to completely shift your portfolio into something else, nor do we recommend that for anyone. What we are only asking people to look at is understand what is that unpriced risk, understand how things are changing around you, and because things are changing around you, um, how does your investment portfolio need to be ready for the future? If you need help with that, we are there to help. So is if you need to take investment advice, then please contact your financial advisor. We are not a financial advisor. We run a hedge fund. We are strategic financial advisors for companies. Now, uh, some of the core principles and the kind of core challenge that the economy is is undergoing currently. Right, that's something that we want to talk about first. Now, always finance is operated, I would say, as if the economy is uh, in a free state of growth and is operating in a vacuum away from everything else that basically powers it. Unfortunately, that is not true. The role of finance is to catalyze the rest of life. Otherwise, finance does not have a purpose. Now, uh, because we treat environment and social factors as externalities, uh, Now, I'm going to give you a stark reality here. Look at the ESG reports of some of the companies. You'll find many aspirational, um, things over there. The data that they are gathering, etc., etc. Now, as you read this, go to their annual report, and there is a section on risk management. And that there is a good chance that in that section on risk management, they will tell you that environmental and social risks are external to our business. By saying that, they have trashed the ESG report right away. There is no point in having that ESG report if it is external to your business, right? Uh, Something that is outside of the balance sheet, not material, etc. That is how they write it. When they write this in the annual report and send it to shareholders, shareholders see this and they basically get that view. But then they are also doing basically a ESG report with a view to use that to improve their asset valuation. Right? If they're issuing bonds, their stock prices as to move up further. The ESG report helps in that uh, in that area. But beyond that, they are not actually embedding ESG into their organization. So first thing, very easy to spot. If you're a shareholder, just look at these two, and then you should be able to spot the companies that are not serious about it in the first place. So you could have also another instance where many companies have, natural capital, clean air, fresh water kind of initiatives as part of CSR, corporate social responsibility initiatives. I'm supportive of corporate social responsibility, but don't call it ESG. Don't call it as part of your strategy because that is charity work, right? You are basically giving some money to charity in order to do something like this. Don't call that as part of the core of your business because it's no way at the core of your business. Better to be truthful about it and say, okay, we contribute to charity, we do this. Yeah, fine, fantastic. That's not part of my business. Now, you, in this midst, we also find some companies which has these initiatives as part of their product, as part of their service, as part of their core offering. Now, if my core offering is sustainable and it operates within that, the sort of boundaries that we talk about. Now, first of all, with this, there are a few, and we basically look at about 200 odd indicators here, right? So I'm not going to bore you with 200 odd indicators. No. One of the first things that we look at is there a fair distribution of resources? And is there an efficient allocation of resources? For that to happen, the scale of your operation and, the distribution, that has to be sustainable, first of all, right? If your scale and your distribution isn't sustainable, there is no point in talking about the distribution of resources and how we are doing this fair thing about this. We are mining oil, etc., etc., doing that, but then we are being so fair about this. We don't kill any animals as part of. No point in saying that. This is a fundamental lie that many companies talk about. So we take these companies, we put them as part of the short book. And one of the things that we find is there is no shortage of companies to be added into the short book because there's so many companies that do these kind of things. Secondly, what we also find is every economic activity that we take up, it's going to consume energy and materials, right? So whether you are saying, I'm running this AI model to do blah, blah, blah. I only sit at home and do this. I don't have an environmental footprint. Sorry, you are consuming energy and materials. Whether you're doing mining, you're doing, oil and gas, or you're doing AI sitting at home, you are consuming energy and material. How do you consume that? And you are transforming, uh, this energy and materials into some form of irreversible waste and disorder. That is how business operates. And you are making money out of that irreversible waste and disorder kind of a process, entropy law, essentially. Now, infinite growth in this kind of a model is a physical impossibility. It's never going to be possible because the resources are always going to be fine. Now, that exposes basically the fragility of your investment portfolio. Now, if a vast majority of your investment portfolio is going to be dependent on depleting energy resources, there is an unpriced risk as part of your portfolio. If you say, okay, I've invested in a food business, and that food business is transitioning from gas into electrification for their industrial heat, for their lighting, for their heating, etc., etc. Everything is electric, and for that electric, they are now dependent on the sun instead of that extractive process of fossil fuel using gas, etc., etc. Now I've got solar panels, and I'm able to extract the electricity from the sun. So with that, you have now created a situation where that physical impossibility because of the energy depletion has gone away. The sun's energy is infinite. As long as you have a solar panel that is able to capture that electricity, capture uh, that energy, convert it into electricity, you are good, right? So with that, what happens is using renewables, using electrification, the fundamental change in by which we kind of look at how emissions, water, and various resources are being distributed. This then changes the characteristic of your investment portfolio. For example, the way we look at emissions is not scope one, two, or three. Right? We don't like to say one big number, scope one, scope two, scope three. No, nobody understands it. My simple way of looking at it is if your business is cement, what is your emission per bag of cement? And with that, is your emission per bag of cement, is it increasing quarter on quarter or is it decreasing quarter on quarter? Now, there have been many attempts to do this via revenue, but that's a fallacy altogether. Your revenue will increase and then automatically you'll show that now your emissions have decreased per dollar of revenue. That's not the way to look at it. I look at it from the product perspective, right? So with that, what happens is you are able to communicate that message very well. If you're writing that on your annual report, then it communicates that message really well. It's the same with board communication. It's the same with customer communication. You can print that at the on the back of your packaging, saying that your bag of chips or whatever it is that you're buying now consumes 5% lesser emissions. It has 5% lesser amount of water needed in order to produce this, etc. That is a very powerful message in the way we kind of look at it, in the way we communicate this. So the third that we look at is ecosystems, right? So everything in this world is an ecosystem. Now we might think about it and say, I went to the supermarket to buy food. It was wrapped in plastic. Hmm, so what? Now these are systems. And these systems are part of ecosystems. Now with this, what what happens is many of these ecosystems provide unpriced services, right? That is a natural capital value. We don't price in uh, the value of the soil, the amount of water that has gone in, and thereby producing this, the amount of oxygen that we got, from the atmosphere, the sunlight that we have used. We don't price any of that. But even if you don't price it, you can preserve it. You can preserve it and you can build through long term resilience and value, right? This is the fundamental framework with which we are looking at these eco leaders and obviously the short book. And as I said, there is no shortage of companies that are greenwashing. There's no shortage of companies that are dropping environmental targets. Thereby, we have a larger group over there, right? Now, looking at what is happening in the market currently, now there is a higher for longer interest rate kind of a narrative that is kind of persisting. And one of the reasons for that is headline inflation is moderating, but core inflation remains sticky. So uh, any rate cuts that happen right now, uh, you know, and into early 2026, it's going to show some amount of pressure on borrowing costs. Companies valuation multiples are going to be strained going forward. So we are observing that very closely, and based on that, we take um, our our bets. Now, for the most part, global GDP growth forecasts are being revised downwards for the later half of 2025 and into 2026. Why is that happening? That is because uh, various issues. Now, with the Trump tariffs, now he said July 9th. He's now said August 1st. It could now. Now the point is, it's not about whether the tariffs are good or bad. It's really about the uncertainty that it has created. With that uncertainty, there is a supply chain related disruption that is taking place. And with that disruption, what also happens is capital investment into businesses will get delayed and there is uncertainty. And with that sort of an uncertainty, then the employment figures that we get are likely to be skewed. Now, talking just about employment, the structure of the workforce is changing as we speak, right? So since about 60s and 70s, you had the MBA boom, and then you find that there is basically you had a mid layer of managers or top layer of maybe leaders, and then basically the doers at the bottom. And then you had a mid layer of managers who are holding things up really well. Now, with increased deployment of technology and automation and AI and better computing power, etc., the need for that thick management layer is slowly going away. Now you're finding a situation where today you might actually ask me, you're not seeing that many job cuts or whatever, right? That big numbers or something like that. Structure of that workforce is changing. Now we are bringing in more number of doers into the workforce, and then slowly reducing that management layer. So if you were in project management, if you were in brand management, if you were in maybe in production management, you know this already, right? Your job is at risk because there is technology that can take over your job quite easily and can do this way better than what you were doing. So many of these roles are getting merged or taken out, right? So what will happen in the next 5 years? I can't say this right away, but what we are saying is basically the structure of that workforce is changing. So you will have a small layer of leadership, a large number of doers, and then a thin layer of management as we go along. So the total number of people employed is not changing, but then the structure of that is changing. Now with the doers, then there is another problem. Can automation come and take over many of these jobs? What happened in manufacturing earlier on? So we were pretty good in manufacturing a lot of stuff. Then we said, okay, fine, fantastic. Let's get machines to do this. So the same thing is happening across sectors. So we will see over the next 5 years doers getting crunched. Now, what is the optimal employment level? That depends economy to economy. But what we are seeing is the whole idea of, of employment, the structure of the workforce, and this underlying fragility that we see. The uh, It signals that if we are seeing a market buoyancy today, it's more structural and driven by specific sectors rather than a broad-based economic health. So don't read unemployment numbers, that too particularly US unemployment numbers are terrible, right? They don't tell you any information at all. Now don't read that and say fantastic economic health. Understand that the structure of employment is changing, structure of the labor market is changing. There is automation in every sector, etc. Now, with that, be aware of what is going on. Then, looking at the geopolitics, there is ongoing troubles in the Middle East, continues to create supply chain related disruption. There is trade disputes, uh, new tariffs, etc. So we've always been looking at this from the perspective of how it threatens the trade flows. But then when I take a step back and look at this, the core eco leaders are the ones who have pretty much local supply chains. They're not uh, you know greatly bothered by the tariffs. Their market is growing because they are targeting younger generations. So with that, we look at one side. How do we identify these eco leaders? We've got 60 of them on our core portfolio, but then we continue to identify more and more. So on our watch list, I think we have another 100 more that we need to analyze and bring them onto the core portfolio. And it's global, sector agnostic sort of an approach that we take. Um, then we also look at the other side, which is the satellite portfolios. That are some structural trends that we uh, which we track, and thereby we are able to understand how things are going in certain specific areas like EV adoption, for example. Now, some of you asked, why is Tesla considered in your short book, not on your long book? They are eco leaders. Shouldn't they be on this? Yes, the product is fantastic, but uh, I see that there is a governance failure at Tesla because the board did not distance themselves from Elon Musk doing his dodgy stuff and launching political parties and whatever. They did not distance themselves. So from that perspective, Tesla will continue to be in our short book until things change from a governance perspective. Now, looking at what is going on in the sort of earnings um, season and etc. There's a lot of dominance for tech and AI. Uh, there's a there's a good amount of outperformance from the large cap, or I can say the mega cap companies, which is kind of driving the overall market indices like the S&P, right? Now then go back, peel back the S&P, take out these Mag 7 and then look at the performance. You see a lot of strains underneath, right? But uh, with with those Mag 7, you find that the growth narratives are fantastic, but technically they are overvalued even today, right? So how do we allocate into those areas remains a question that is quite tactical, not strategic. And the reason why I say that is where we see AI today is maybe where we saw dot com back in 99, right? So AI has a lot more to go before it becomes mainstream, it becomes material, and it becomes very, very important to our routine lives. Today, we are chatting with AI, we are using this for content, etc., etc. But a lot more things can happen with AI, and we will continue to observe that as we go on. So many of the traditional sectors, industrial, consumer discretionary, um, taking retail, all of them have softer guidance. So take the S&P 500, peel back the tech and AI sort of influenced stocks, and look at the guidance that we have with all the other maybe 400 and 440 plus stocks. Looking at that, they are looking at persistent inflation, higher input cost, tariff related pressure, cautious consumer spending. These are the terms that you're getting pretty much. And that is pretty similar if you basically look at it across markets, right? Every market that uh, which you can think of, you see exactly the same narrative. Uh, now, um, then the next area that we looked at is how is sustainability, ESG, environment, etc., being mentioned as part of earnings calls, right? Now, what this means is that currently we find that there is a decline in the number of kind of downward trend in terms of mentions of these terms in earnings call summaries, right? We go and, upload thousands of earning call summaries, and we look for sentiments in this. And based on that, we find that there is an overshadow with geopolitical tensions, with tariffs, etc. But then underlying all this is a fundamental weak business model. So all of those companies that have dropped mentions of sustainability, you find that there is a weak business model that is vulnerable to these, uh, underlying changes. Right. Then looking at what is happening in the commodity markets, um, oil, we continue to track oil prices. Now, I said, I think a couple of weeks ago, um, while there were like small spurts when we looked at oil at the center of the market, predominantly post the financial crisis, what we have done is we have kept oil prices pretty much like oil is trading at that number, and I'm not really taking that into account as part of my analysis going forward. Now with the narrative that is there in the US, drill baby drill, and etc., we are bringing oil into the center of the economy. We are trying to bring that as part of the narrative and bring it into the center of the economy. While that is happening, the other side is also that uh, the renewable transition continues, the EV, etc., that continues, and China is becoming more and more dominant in this area because of critical minerals and their manufacturing capacity, etc., which all the other Western economies will not be able to match. So with that, what we are seeing is the price for various critical minerals will continue to be dominated by China, and thereby you can have supply chain bottlenecks, you can have geopolitical competition for these resources. So that highlights another unpriced risk in your portfolio. Then we also look at the agricultural commodities that are very, very important. Now you'll come back and tell me, we are a service-driven economy. And, the UK GDP is 80% services. So you still have to have food, right? You still have to have, various agricultural commodities as part of your day-to-day life. And many of these services depend on the use of agricultural content. It's not going away, right? You can call yourself services, but it's not going away. What we see over there is the continued climate related events. Uh, it's impacting crop yields. There is price volatility and there's increased concerns around food security, which again is unpriced in your investment portfolio. So are you looking at that? Probably not. Right. And these are the areas where Helix specifically works on in building a modern portfolio and how we work with family offices in modernizing their portfolio. Now, lastly, before we kind of close our session for today, I want to touch base again on the aspirations gap, which we spoke about first. We said ecoeconomics largely influenced by this aspirations gap, the under 30 generation. Unlike previous generations, the under 30s are less focused on traditional markers like, I want to own this house, I want to own a car, I want to accumulate various material possessions. Now, the key here is experiences, purpose, flexibility, digital interconnectedness, and a deep concern for social and environmental factors. Now, we might say these guys are fickle minded, they don't care about this, they will change. You might be right. But then what we see is when there is the first opportunity for them to sign up a utility provider, they're signing up a renewable provider. When there is the first opportunity to, uh, maybe rent a house or whatever, they are looking for places with better energy efficiency, better insulation, etc. When there is a first opportunity to look at how I commute into the city, they are looking for public transport connection, they're looking for bike storage, safety, that, etc., etc. They're not looking at buying a diesel car and basically putting it in front of their driveway. Now we study this. We use researchers from the University of Edinburgh to study this every quarter. We study about 5,000 people who are part of our survey population, and we see these trends taking place, and we understand that there are certain brands that they are influenced by. The way they work is also different. Now, looking at the way they work, fundamentally, we can say it is a purpose-driven company, and that influences these people, etc., etc. That is a very oversimplification, right? Uh, Strong sustainability credentials for their employer, having a transparent supply chain, an ethical, um, mindset, uh, having access over subscriptions, various trends that we see among the young workforce that basically comes in today. So if your company is looking to attract young workers, now you could be saying, I only employ people that are 50 plus, and you don't need to bother about this. But if you are employing younger people, if you need maybe a graduate or maybe somebody in the early stages of their career to come work for you, you better be aware of this because their mindset is not the same as your, you know, uh, older generations, right? So companies that are failing to adapt their work environments, products and services, etc., they are not able to attract the younger generation. It's very, very clear. So globally, we surveyed nearly 1,000 brands. We found a vast majority of them do not even consider the under 30s as a demographic worth engaging with. And what we find is looking into market shares, their market share is very, very low from the younger generation. So going forward, if you are investing in those companies, big consumer brands, etc., then and if a majority of your portfolios is companies that don't take this into account, you're likely to see lower investment returns as you go on because there will be other brands that will take over, right? Uh, there's a huge influence in the market, both the labor market, the talent related struggle that we see, right? And they are also influencing the investment trends. As I said, those companies that are able to attract them, they have a better chance in the future. If you're not in that, don't worry about it. You still have maybe 5 years to continue business, but later on, you will find that your market is taken over by somebody else, and that has happened already in many sectors. Right? I'll talk about a few other sectors in our next week, but overall, that's pretty much our high level update right now. We continue to look at the eco leaders. Nearly 50% of our portfolio is targeting the eco leaders. We take about 30% bet on the satellite portfolio, which is various structural bets that we take, and then we have a number of companies that are subject to greenwashing litigation, um, or they are dropping environmental targets, so they become part of the short book for us. And we also use overlays, which give us exposure to various other markets, and thereby with that we are able to generate a significantly higher uncorrelated return on our fund. So our advisory journey is also quite similar. We look for eco leaders, or we look for companies that are adopting uh, these green technology, sustainable technology, and we are able to advise them. We're able to get a much better deal from the market than any other companies um, uh, which are in the market. Lastly, please be aware of the unpriced risks in your portfolio. I will write about this a little bit more in detail next week, where we are finding that this unpriced risk could become more material as you go along. Right? Thank you. If you have any questions, please feel free to post that in the comments. Um, the recording should be available on your email very soon, and we will also be posting a few clips. Well, right. Thank you.